After 9 years of soaring stock markets, global share prices have stumbled. Last week's turbulence was played down by many commentators who brushed it off as a necessary correction. But some prophets of doom countered the soothing consensus with warnings that this was a tremor before the real earthquake strikes. Either way, investors are feeling jittery. The email on Sunday outlines key remedies for investors, savers and pensioners suffering from stock market stress. The old stock market adage that, when the US sneezes, the rest of the world catches cold has lived up to its name in recent days. The UK's main index, the FTSE All-Share, slid to a one-year low on Tuesday after the US Dow Jones Index suffered its biggest fall in 6 years. It drifted down further, ending Friday at 3,895, 4.6% down on the week.The reason? Initially, fears that interest rates are rising faster than anticipated in the US, pushing up borrowing costs and denting corporate profits. These anxieties then spread to the UK as the Bank of England indicated interest rates might need to rise 3 times this year. Ben Yearsley, of financial advisor Shore Financial Planning, believes the fears are overblown. Investors should not panic. But an analyst at Dutch bank Rabobank says playtime is officially over. The worst thing to do is sell shares or investment funds in a panic. These are investments designed to be held long-term. Stock markets have a tendency to bounce back over time. What is more crucial is to ensure your money is well invested in terms of diversification and quality. Leif Calip, senior analyst at broker Hargreaves Lansdown, says the market turbulence should act as a trigger to check your investments are fit for purpose. When markets move, previous investment choices can start to look out of kilter with maybe too much money invested in one specific area. For example, you may have too much exposure to the US, a market which still looks expensive compared to others. Options to consider when rearranging investment assets include buying unloved areas, such as UK shares and UK invested funds, hit by Brexit uncertainty. Also Europe, where economic recovery is starting to come through. Japan is another option according to Marcus Stableman, Chief Investment Officer at Lloyds Banking Group. He says, Japan is implementing a successful economic reform program, and the cash flow growth of its leading companies is the strongest of all the world's economies. Jason Hollins of wealth manager Tilney says it is vital to scrutinize how your investment funds are performing. He says, do not assume an investment fund that has risen in value is necessarily in good health. compared to the competition.UK equity income funds which invest in dividend-friendly companies can partially protect against stock market ups and downs. This is because dividends are paid out, even if the shares of a company dips, providing investors with a cushion. The income generated from such funds can be automatically reinvested, building an investor's fund stake. Many investment trusts have an impressive record of paying growing dividends going back decades, including years when stock markets have suffered sharp corrections. Among them are Alliance Trust, Caledonia, bankers in the City of London. Spreading money between different kinds of investments, cash, bonds, shares and property, also helps reduce the risk of a portfolio being undermined by share price falls. Drip-feeding money into shares and funds reduces the risk of buying just before a stock market fall. Caliph says, if you want to make the most of this year's ISA allowance of up to £20,000, make the contribution in cash before the deadline of April 5, and then invest gradually after that. Now is also a good time to consider moving investments into an ISA. Caliph says, you can do a so-called bet and ISA. This means selling an investment, crystallizing the gains and taking advantage of the annual capital gains tax exemption of £11,300. You then buy it back within a tax-free ISA, where it will be free of future capital gains tax and income tax. Pensions are long-term investments. Savers who are years away from retirement should put volatile stock markets out of their minds and carry on contributing into a pension. Keith Richards is Chief Executive of Financial Advisor Trade Association, the Personal Finance Society. He says, the worst thing to do now is stop paying into your pension. Just as markets correct and fall, history shows they will rise again. Think of it in terms of an aeroplane hitting pockets of turbulence. Volatility is perfectly normal, and just as an aeroplane is designed to fly in rough conditions, good financial planning should mitigate any fears you have over the security of your long-term wealth. Those with a defined benefit company pension should sit tight as their future retirement income is dependent upon a combination of years worked and salary. It is not directly impacted by adverse stock market conditions. But those on the point of retiring with a money purchase pension, the value of which is determined primarily by share prices, face tougher choices. As to those already drawing an income from their pension by part selling holdings, Vince Smith-Hughes, retirement expert at pension provider Prudential, says those selling funds within their pension to generate retirement income can suffer from so-called pan cost ravaging, where in order to generate the same income they are forced to sell more and more investments. He says those in the early years of retirement should be prepared to reduce the size of withdrawals from their funds. Despite stock market falls, the safe haven of cash is still looking an unattractive alternative. The best easy access account is paying just 1.3%, which on a balance of £85,000 provides annual income of £1,105. The top one-year fixed-rate bond pays 1.95%, which earns £1,658 on the same sum, but with no prospect of an income boost if interest rates rise in the next 12 months. Savers might be best dividing savings between different accounts. They can then take advantage of both the higher rates of interest on fixed-rate bonds and the hope of a better income on variable accounts when interest rates rise. While ensuring savings and investments are fit for purpose, households should also take time to run a slide rule over utility bills to see whether they are paying over the odds.